Hi everyone, very good evening to all of y'all. I am Fiza. I am from HDFC Securities family and manage as a regional head for the corporate channel. I'm sure we all are here today to have insights about the Indian economy and its market. And for this, I would like to tell you a secret from us. HDFC Securities have gems, a treasure box with a lot of gems with us. Today, I bring you two gems from it, especially for you all. First is Mr. Manish Kumar, who heads as the zonal head for the west region of the country, which is one of the largest region of the HDFC Bank and as well as the financial hub of the country. He is one of the old resource in the system and knows each and everything and is a master in his work. So Mr. Manish will brief us today what bank are making changes for its stakeholders to improvise their all and ease their banking. And post Mr. Manish, Mr. Aman Dwivedi, who is our senior analyst from HDFC Securities family again, will take us through the Indian economy and its market. Trust me, guys, when I tell you, Aman is an ocean of its knowledge, the master in his own field. So do not hesitate to ask him any questions. And I'm sure he will love to answer you all on this piece. So, without wasting much of the time, I would like to hand over to Mr. Manish to come and start a brief about the banking piece. Mr. Manish, please.
Thank you, Bija. Fiza. Good evening, everyone. I am Manish Kumar, Zonal Head Corporate Salary from HDFC Bank at Mumbai. It is my privilege and honor to welcome you all for this exclusive webinar, and I wish you all a good health. On behalf of HDFC Bank, please accept our sincere thanks to all our esteemed customer and to all our prospective customer. I am sure all of you are taking good care, meticulously following all the requisite safety guidelines in these challenging times. I wish to convey that HDFC Bank to be a one-stop shop solution for all your banking needs, be it lending, investment, and that's with the best ROI, assuring you best of our services. And I'm sure that our dedicated CSRM KCMs are taking good care of you and your corporate and serving you and your corporate as well. While we keep in the current new normal era, we are witnessing lots of debates on Indian economy, how the things are moving on and how it is going to be shape up in coming month. While we keep listening that also various agencies and even the RBI keep revising the GDP estimate, which is considered to be one of the barometer for the Indian economy. In today's sessions, we have an experts and we are going to talk about the Indian economy, the way forward. The major category traditionally, if you'll see, in to identify the health of an Indian economy is primarily four, which I can correct, which is one is your consumer economy, where we see the automobile sales. And since being part of the employment and recruitment drive, we understand that more than 20 million people are employed in this sector. And also GDP contribution wise, 45% of manufacturing comes from this auto sales. Then second is your our industrial sectors, so which is also again paramount of important in laying the foundation for any economy. So whether we talk about the PMI or we talk about the gross fixed capital information for any country, and also electricity consumption and performance of the manufacturing sectors, where also we are seeing now the changes. Third factor is our external factors, so which is our current account deficit against the percentage of our GDP, import cover, and most important for a country like us, where non-oil export is triggers how exactly the economy is going to behave. And fourth, which is more relevant, in fact, I'll say from retail side perspective, is your ease of living indicator. So whether it's my consumer price index, we see the rural wages, which we are witnessing also, the rural wages and the contract and subcontracting work, which in our corporate and their allied services they are getting and they are getting employed. And third is also unemployment index, which is also this. So we all have seen that the last year, say, we are discussing lots of debate and we are hearing, okay, since most of the indicators were last year in the red zone, and we were debating about whether it will do a recovery, will be a V shape, W shape, U shape, K shape. We keep discussing this. But ultimately, as a country, as a nation, our ambition was, that we wanted to reach this $5 trillion economy. And now, because of this pre-pandemic second wave and other things, where things are improving and other things, there are lots of questions which are coming in our mind, and we wanted, to understand and debate more on this. So, without wasting much time, also we are very excited that sometimes when I was reading an article and it was discussion the role of vaccinations on the economy. So 100% vaccination is directly proportional to something will happen good with the economy and this. So we have various our customers and the team members on these points. And without wasting much time, this over to you, Aman, and we look forward to hearing from you. Thank you.
Thanks a lot, Manish, for that insightful discussion and insightful opening to the discussion today. Just before I start, let me give you a little bit of a background about myself. I have been an equity research analyst now for close to 20 years. During the time, I've studied various sectors. I've studied FMCG, banking, infrastructure, autos, you name it. I've studied that, tracked these companies for a long time. I've been in the market throughout, so I've seen the downside that we saw during the global financial crisis. Obviously I saw the decline, the taper tantrum sometime in 2013, and of course the last year's COVID crash that we witnessed, and the sharp recovery thereafter. So I'm able to bring a lot of that experience on to today's discussion. I have prepared a short PPT which I'll start sharing with you on that. Now, I have divided the PPT into three parts. Sorry, I have divided the PPT into three parts. The first part is what I call a decade in review. Now, the entire focus of this particular PPT is going to be on in terms of longer term trends, because the entire idea of this PPT was to look at the next 5 years, not just the next 12 months or the next let's say 2 years. So the mandate that was asked to me was to look at some of the longer term trends. In order to understand some of the longer term trends, it's very important to understand some of the history that we've gone through. So that's the first part. The decade in review is what I call it. Um, Hopefully some of the lessons from history can be extrapolated to looking at the future going forward. So the first thing that we notice when we look at this particular graph, which has the GDP growth rate over the last 20 years for some of the major economies in the world, like China and USA, as well as for India. So the main thing to notice is that the period between 2011 to 2020 was a relatively weak period of growth for the world. The main culprits were China. Their growth rate slackened significantly from 8% plus to maybe an average of 6.5% or thereabouts during the 2011 decade. Similarly, USA, which had in between hit peaks of as much as 4.5%, actually grew only at 2.5% during the second part of during the 2011 to 20 decade. That pulled down overall global growth rate. India was relatively better, I would say, still probably managing a close to 7% CAGR growth rate during the period. More recently, the economy had been weakening well before the COVID crash took place, well before the March lockdowns impacted the GDP growth. But one of the main culprits for this was probably the IL&FS bankruptcy, which actually created a lot of problems for other NBFCs as well. And the other NBFCs went straight from growth mode to conservation of capital mode. And that really impacted the credit demand and the subsequent GDP growth rate. Inflation, was very high in the early part of the decade, but the latter half of the decade, certainly it had come down quite sharply. The government, the RBI was cutting, the repo rate, and the domestic yields were coming down even before the COVID. But once COVID hit, RBI went into an overdrive and brought down the repo rate to 4%, and GDP growth rate and the 10-year yield was as low as 5.8% at one point in time. Despite these, over the last 5 years, despite inflation being in control, despite yields being I would say, modest, credit growth was very, very poor. This is a chart that shows credit growth from the beginning of 2015. Credit growth had been consistently below the 10% mark, hitting a low of 3.6% in June 2017. This clearly shows this in part was driven by the supply side challenges that the public sector banks were facing. They were saddled with lots of NPAs. They were short in capital. Many of the PSU banks were put in the prompt corrective action framework. So because of all of that, the supply side of bank credit was clearly impacted, and that also had a impact on the GDP growth rates in the second half of the decade. There was a very sharp trend from, let's say, 2014 onwards, where the banks started focusing more and more on personal and consumer loans and shied away from industry loans. And the share of industrial loans dropped sharply by almost from 43% to about 33% in the total bank credit. So that was a sharp decline. That had a significant impact on the economy in the period prior to the COVID crash. So what did it translate to in terms of returns for equity markets? Clearly, the 10-year returns, as you can see, were fairly modest. In for the Nifty itself, it was around 11%. For even mid-cap Nifty, it was about 13% CAGR over a 10-year period, and for Nifty small cap, it was 10. Again, it was 10.2%. It even underperformed the Nifty itself, and this despite the fact that over the last 1 year, we've had a 60% rally in Nifty, 122% rally in small cap index, and a 93% rally in mid cap index. Despite the strong rally, the 10-year returns were relatively modest from the equity markets. But it was not. Uniform. The next set of graphs will. The next set of graphs will show you which are the sectors that outperformed. And this is a very interesting chart. In the decade, and now talking from Jan 2011 to about November 2020, Nifty gave a 145% return, but FMCG was a standout performer, giving a 300% return. The IT index was the next best performer, 225% returns. NSE Bank, which was largely led by private sector banks, was again a strong performer. Pharma also outperformed Nifty. Pharma, in fact, was one of the best performers till 2015. But because of a bunch of issues with the FDA, and then followed by a significant price erosion on US generics, the returns came down in the second part of the decade. But you have to look at how relatively narrow this particular graph is. You have four sectors which have outperformed handsomely the Nifty, and in fact, these four sectors tended to pull up Nifty quite a lot. But when you look at the next slide, this is the slide. This is the slide, sectors that underperformed. And this really tells the story of India's economy over the last decade or so. The infrastructure sector gave only a 19% return, and large part of that probably came from L&T. A lot of the infrastructure companies that were leaders, let's say in 2008, 2000 or thereabouts, they struggled a big time because of leverage, because of delays in completion of these projects, and so on. Real estate, again, similar problems. Leverage plus delays meant that real estate performed very poorly during the entire time. Metals, like we spoke, like we talked about earlier, global growth had been relatively modest. Supply side more or less fairly met the demand growth for metals and commodity and metals as well as oil and gas. And commodities basically gave very poor returns, at least till December. In the post-COVID era, there was a sharp spike in many of these commodities, but at least in the 10-year period that we saw, the returns were very poor. The clear standout here is PSU, Nifty PSU, a 10-year decline of, a 10-year negative return of minus 56%. Clearly showed the story. A lot of struggle for PSUs across the board. Banking sector, PSU banks were saddled with huge NPAs. Companies like Oil and Gas or Oil India or Coal India were struggling with the realizations or even growing their output. Companies like BHEL or BSNL, etc., were MTNL, sorry, not BSNL. MTNL had their own challenges, competitive as well as demand side. So clearly, the last decade was in many ways for equity markets and for large portions of the economy something that were relatively weaker than what you would have expected at the beginning of the decade. That was probably disappointed many people. This is another interesting graph to look at. Here we show the returns of Nasdaq, the US 500, and the US 2000 Russell Index. The S&P US 500 actually outperformed the Nifty 500, both in USD terms as well as local currency terms. And if you look at Nasdaq was really the standout performer during the last decade. That's why we call this the decade of technology. The new tech companies like an Amazon or a Facebook or a Netflix give significantly higher returns compared to your traditional old economy sectors like staples or banking and other sectors. So technology was clearly the outstanding performer during the last decade. Um, and this was again a decade of growth stocks. Now these are growth indices for the US. The higher index is growth index for the US. The lower index is what is called a value index for the US. Clearly, the outperformance of the growth index is very stark when you look at it over a decade. Um, this was replicated in most other countries as well, including in India. And growth stocks in India over the decade really outperformed the economy stocks, really outperformed the value stocks till the end of the decade. Again, a very important lesson. When you look at a 10-year chart, you really realize how stark the differential has been between different sectors, between US, between technology, and so on. Right? This is a chart that we came across and we found it very interesting. We call this the decade of renewables. Uh, the this brown line, sharply falling brown line, actually shows how dramatic the fall in cost of renewable energy has been. So in the beginning of 2010, this was 378 dollars per megawatt hours, had fallen to as low as $68 per megawatt at the end of 2019. And the installed capacity, which was probably a little less than 40,000 megawatts, global installed capacity, went to more than 500,000 megawatts at the end of 2019. So onshore wind, offshore wind also had similar significant drops in costs, though not matching as much as solar photovoltaic cells. Right. So this was again a decade of renewables, so to say. Now moving on to the second part of the thing. What do we think about the next 5 years? So instead of talking about GDP, instead of trying to guess what GDP growth rate will be, what inflation will be, what capex will be, we thought it prudent to try and understand which particular themes might work for the economy. Right? It's not only about just GDP and this thing, But what are, let's say, some of the structural changes that are driving the economy that are likely to be important over the next 5 years? Not even just next 5 years, probably over the next decade as well, over a longer time frame as well. So these are four themes that we thought were important, and to keep track of for the next decade or so. One is, of course, the consumption growth. The case for consumption growth is very well known. India is a growing economy. Per capita income is rising. Middle class is becoming larger. There's a large aspirational class that we see. We have a young workforce. So all of that, would contribute to consumption growth. So some of the key sectors that will benefit, like a banking, consumer, whether it is staples, whether it is discretionary, or any consumer facing sectors, would probably benefit from this growth. Pharma, of course, stands to gain. The second big theme that we looked at was underpenetrated, right? When we say underpenetrated, what we are saying is they are large sectors, but only a very small portion of the population is so far accessing some of these things. So in financial services, like if you look at asset management companies, if you look at credit cards, if you look at insurance, if you look at autos, right? When I say about autos, I'm talking about cars. The penetration is still very low. Refrigerators penetration still very low. Washing machines, negligible penetration. ACs again can be a great multiple growth that you can see in some of these consumer durables. Particularly, we are today probably a little close to $2,000 per capita in income. Over the next decade, there is a very good likelihood that we'll probably reach closer to the $5,000 per megawatt, $5,000 per capita income. When that transition happens, what you generally see is a very significant change in the consumption patterns of the economy. Consumer durables become important, automobiles become important, housing becomes important. So that's again, a theme that will likely drive the transformation. The third one is what we are calling the transformation, which is the thing that we just spoke about. When your per capita income increases, let's say from 2,000 to 5,000 over a decade, the kind of things that you're buying starts to change. So, for example, fashion, you start buying better brands, more premium brands. Retail, you probably, instead of shopping in the nearby store, you're probably looking at malls. So you're looking at organized retail. In terms of what you buy, paint, ceramics, etc., the consumption really increases substantially. Processed food and dairy, very small part of the economy, very small part of the organized economy, so to say, today, but can substantially change over a decade as per capita incomes increase. The fourth theme that we like is the export-oriented theme. Information technology has done wonders over the last 2 decades for the Indian economy. The growth and the returns that you've seen from the sector are among the best in the economy. You have that a lot of that success has been replicated by pharma. US generics, India has a very large share of US generic pharma market. We are already on the path, but we think over the next 5 or 10 years, contract research, contract manufacturing, specialty chemicals, many of these themes will become important. So this is again, one theme that we like, both for the economy as well as for investing. Now, talk a little bit more about consumption growth. We've spoken about how urbanization is taking place. You're seeing currently with 34% or thereabouts urban population that will significantly increase over the next decade. Our so-called affluent and elite households. On the right-hand panel of the graph, you see 6% of the total population today is considered. 12% of the total population today is considered affluent and elite. This has actually doubled in the last from 6% in 2010. but very likely this will again double over the next decade. What does all of that mean? Now we look at the left-hand side in terms of consumption expenditures, and these are BCG estimates, not our estimates, but these are BCG estimates. Total consumption had tripled in the last decade, from 40 trillion rupees to 120 trillion rupees. But over the next decade, it will again triple. So that's the bet that analysts at BCG are making. Clearly, consumption will be one of the big themes for India, and hopefully one of the big drivers for growth in India. Um, this is something that many people talk about in terms of China plus one strategy. What it basically says is that all global companies are looking to diversify out of China. They have become very heavily dependent on China for intermediate goods, for finished goods, as a country of origin for the products that they manufacture. They are now looking increasingly towards other countries to source at least a part of their production so that they're not completely dependent on China. This is called the China plus one strategy globally. Southeast Asia has been one of the biggest beneficiaries of this. Particularly, Vietnam has been at the forefront of this. Mexico has benefited from it, but India also, ranks very strongly there. To the credit of the government, the government has come out with this PLI scheme, the Production-Linked Incentive Scheme, targeting a wide range of industries, from electronics to automobiles to pharmaceutical and storage batteries and so on. Hopefully, at least some of them will be a good success, and we can hope that at least some of the manufacturing base expands. Now, moving on to the other side, to another big theme, unorganized to organized. There were great hopes that when GST came in, there were great hopes that organized sector would grow very fast. That has not happened because unorganized sector has fought to retain some of the shareholding that it has. But COVID has really impacted this debate. So the big beneficiaries of the COVID wave have been e-commerce, and so they doubled their market share from 3% in 2019 to 7%. Similarly, organized retailers also significantly improved their market share from 9% in 2019 to 18%. The big loser has clearly been the unorganized sector, which has struggled to be able to source the material, to keep its shops open, to pay the rent, and so on. But this is something that had been happening for a long time. Organized as well as e-commerce sector had been gaining share, and that is likely a trend that continues for the next 5 to 10 years as well. So this is again something that benefits the organized sector. The big we talked about the performance of Nasdaq over the last decade, but clearly there is still a long way to go. Across the world, people have started investing more and more into their IT systems. COVID actually gave a very large push to digital spending by US corporates in particular. There was significant increases in the budget, be it cloud, be it mobility, be it analytics like AI or ML. One of the big themes that people believe will be for the next decade will be IoT. A lot of use cases are now gaining traction, but it will be interesting to see. IoT will probably be a big theme over the next decade. So technology is clearly going to be one of the big themes for the next decade, clearly. Now, India also has had a lot of investments in the tech sector, what we call the startup sector or the venture capital sector. We already have more than 55 unicorns. Unicorns are startups which have gained a market capitalization of at least $1 billion. So you're talking about 55 already. You have 55 unicorns across already. You'll probably reach 100 unicorns by 2023, as per some of the analysts at Business Line. You see the spread of these unicorns from consumer to e-commerce to fintech to enterprise technology, and to mobility and so on. So great amount, hugely varied spread. India seems to be clearly a fertile ground for many of these startups. Many of the existing businesses, be it in the banking space or the financial services space, be it in hospitality, be it in leisure, retail, all of these will face challenges from all these startups. I think the biggest challenge will not for the existing old economy companies will not be from traditional rivals, but it will or from new entrants from, let's say, in the MNC world. But the biggest challenge for their business models will come from the startup space, which is what we are seeing. Amazon, after being very successful globally in terms of delivery, they started looking out at pharma. They started looking out at something like a Whole Foods for a physical retail. So they have obviously a Prime Video, Prime services across the board. So clearly there is a huge amount of challenges that are coming in from these new players. So something like a Paytm now is looking to be a mutual fund distributor, is looking to be an asset manager, looking to be a lender. So everyone is there's clearly several of these tech companies are looking at areas beyond where they originally started, and looking to expand their services and challenging the existing old economy companies, right? Now moving on to the next slide. Clearly, electrification will be one of the renewables will be a big theme for the next decade. Wind and solar together are likely to overtake something like the largest source of electricity, which is coal, by 2024. That is true globally. In India, it will take a lot slightly longer time, maybe in the 2030s. But clearly, this is a trend that is gaining traction and is here to stay. Um, Adoption of EVs. This is an interesting chart prepared by BCG. What they're basically saying is today, roughly 75% or roughly 90% is internal combustion engine, right? Petrol or diesel. But by 2035, that market share would drop to as low as 12%. So that's a huge impact on on passenger companies, on auto ancillary companies, on oil refiners, and oil crude suppliers, and so on. That's going to be a huge change going forward. So very interesting trend. Should be aware of how it is going to impact the economy going forward. So these were some of the long trends that we notice, and there are others that we may have missed out. But clearly, the next decade will be a decade of structural change in many ways, from the emergence of technology startups to new technologies, and complete changing the way how organized sector competes and unorganized versus an unorganized sector, what is actually demanded, what people want to consume. So we will see a significant shift over the next decade going forward. The third part of the presentation is about the current equity market scenario. We get a lot of questions around that, so I said we will put a section there to discuss how the current equity market scenario looks, probably in the shorter term. So this is an interesting chart that Goldman published a couple of days back. This shows the global equity flows year on year, every year, in the first half of every year over the last 25 years. The global equity flows in 2021, first half of 2021, was $517 billion. This is more than 2.5 times the previous record that was set in 2017. Clearly, you've seen a lot of global stimulus from every country in the world, be it US, UK, Europe, Japan, to a certain extent even in India. So all the monetary policies are about keeping interest rates low, uh, keeping a lot of liquidity in the market, asset purchases. A lot, and the second part has been the fiscal stimulus. So US has already given 3 checks to its citizens, is now talking about an infrastructure push. So clearly, a lot of that money is now funneling into different asset classes, and equity has been one of the big beneficiaries of these flows. Record inflows into global equities over the first half of 2021. India has also been one of the biggest beneficiaries. If you look at Asian flows, India has been a standout outperformer. India gained a huge amount of FI inflows in the equity markets. FIs have been relatively lukewarm to the debt markets, but equity clearly a huge amount of inflows over the last 12 months. I believe again a record amount of inflows in such a short period. What has that reflected in? Obviously, like we spoke about, Nifty's done really well over the last 12 months since the bottom that it made sometime in March. People are now, of course, worried about where the valuations are. This is a PE of what of the Nifty on a trailing earnings basis, right? So it peaked at about 42, but because over the last 3 quarters earnings have been very strong, the PE multiple now on a trailing basis has come down to 28 times. Market participants generally do not look at trailing PEs. They will generally look at forward PEs. FY23 is the PE. FY23 earnings estimates are range from 750 to 770 rupees. At that valuation, we are probably 20 to 20 and a half times 1 year forward or 2 year forward earnings. That is close to its highs that it has historically been trading, but uh, earnings growth will probably be a key factor to look at. We spoke about this early. Mid cap and small cap indices have had an even stronger rally than the Nifty large cap. But if you look at 2000, December 2017 levels, it's still fairly, I would say, modest returns, so to say. If you were to look at it from a 3-year CAGR perspective. So what's our equity outlook? Varun Lochab is the head of research of institutional equities at HDFC Securities. He very recently published a strategy note in middle of May. He covered a lot of topics in a very short space, and this is very interesting, right? Nifty P at 20.5 times FY23 earnings per share is probably fairly rich. We generally do not tend to trade more than 21 or 22 times. So clearly, rich valuations limit the room in terms of PE expansion. So PE expansion, which is quite often one of the drivers of investment returns, is unlikely to expand too much. However, earnings growth over the next 2 to 3 years is probably likely to be fairly strong, and we say that because there is a lot of things that have improved relative to the last 4 or 5 years. Banking and financial sector, which had suffered over the last 4 or 5 years because of NPAs and so on, has now finally been able to more or less come out of, more or less deal with those problems, provide for where they could, sell where they could, and now structurally seem to be in a better side of the cycle where return on equity for some of the large private sector banks like ICICI and Axis, or even for PSU banks like SBI, is likely to be better going forward. So what are the sectors that Varun likes? Clearly his preferred sectors are IT, infrastructure, large banks, infrastructure came again, consumer durables and so on. IT, we've spoken, huge push from the COVID pandemic. A lot of people, a lot of companies globally are investing in their digital capabilities. Infrastructure, a huge focus area for the government. In the recent budget, a lot of expenditures were cut or stayed the same, but infrastructure really saw a push. That's the sector that the government really likes and wants to push there. Large banks, I just mentioned, cyclical turn. Consumer durables, huge long-term opportunity, significantly underpenetrated one. Insurance, again, something that is hugely underpenetrated. What are Varun's least preferred sectors? He doesn't like staples, doesn't like discretionary or autos. Uh, these are mainly because of valuation concerns in the sector. Obviously, there are a lot of good companies in the sector, but valuations have now probably become a stretch. Um, the narrow outperformance that we saw the last decade, when only the IT, consumer, pharma sectors are doing well, will probably change now because a lot more companies are likely to do well going forward. Varun runs a very interesting model portfolio. He's recently added stocks like Cummins, Phoenix Mills, ONGC, L&T, L&T, L&T Infotech, and Sonata Software to the sector. Some of the model portfolio exclusions now were Alkyl Amines, TCS, and HCL. So clearly, over the next, let's say, 24 months or maybe 12 to 24 months, the returns have to come from equity earnings growth. It will probably not be from further expansion of P multiples. P expansion will probably be a smaller factor going forward. So this is now a time not to just buy the market blindly, but to be very, very selective and very, very careful in the companies that you invest in, the companies that are likely to do forward. What are the risks to our thesis? Obviously, we do not yet know impact of Delta variant. You've seen Sydney in lockdown. You've seen Indonesia suffering from oxygen shortages. This clearly something that we have to see how this particular wave plays out both in India as well as globally. Inflation and bond yields. Inflation across the board has been very high. Uh, a lot of the economists believe that this is just a reopening trade in some ways. Therefore, inflationary is transitory. Bond yields have been very, very well behaved, in a narrow band where you would expect them. So but that can change. So that's a risk. That's something that you should monitor. The third is to look at the demand indicators. Clearly, after the reopening, there has been a very significant bump up in demand because of the pent-up demand that was there. Can this high demand environment sustain? So that's a question that people are debating. So these are some of the key risks. I think that covers broadly the section that I wanted to cover. Half an hour was what we had planned on this. I think we've taken up the half an hour. I'll be happy to answer any of the questions that you have. In order to ask questions, you will have to look at the questions chat box that is there on the screen and type in your questions there. We will wait for a minute for the questions queue to start to begin. If you have any questions, please include in the chat box here.
Dear participants, to ask any questions, please click on the question mark on your screen and type in your questions. I repeat, please click on the question mark icon on your screen and type in your question.
I don't know if you're not able to type in, but we don't see any question yet. Sham, are the participants able to type in the questions?
I believe there are no questions yet.
Okay. We'll wait for a couple of minutes. Okay. I think one of the first questions has come in. I think Rashmi has asked this question: how recruitment what will be effect on recruitment what will be the effect on recruitment of the economy that we are seeing? So clearly, uh, c- like I mentioned, just to answer first of all, some of the key sectors that are doing well. IT sector is doing very well. IT sector is also doing fairly well and is expected to do very well. They have been very large recruiters in the organized sector. They will continue to be so. Banking, financial sector, insurance, some of these BFSI, again, we talked about how underpenetrated some of these sectors are. They should also do well. Select manufacturing sectors could do well, particularly those which benefit from the China plus one strategy. Which are the sectors that will struggle? Clearly, the unorganized sector, which is getting disrupted either by e-commerce or which is getting disrupted by organized players. That is something that will struggle. Um, so that I hope answers your question, Rashmi. The other questions from Fiza, she wants to understand: can we overall be still bullish at this levels too? My sense is you should be bullish at these levels. The reason for being bullish is because we are in probably the best earnings growth trajectory that we have seen in a really long time. Earnings growth had as a percentage, corporate earnings as a percentage of GDP had fallen to as low as 1.7 or 1.8% from a traditionally 3.5 to 4% levels. So earnings growth should be strong. That is the reason why I would rather be bullish than look at only at the valuation. Having said that, you have to be very selective in terms of the stocks that you pick. The key things that you should always look at is first you should look at quality. Second, you should look at leverage being low. Third, you should look at valuations being good, and fourth, you should look at earnings growth. So we still like a lot of sectors like um, insurance or private banking or asset management. We think there is still a lot of value in some of the auto ancillary stocks, some of the oil and gas stocks, some of the infrastructure stocks. They're still very fairly attractively valued. So we will be selective in picking the stocks that we like. Pharma and IT are still reasonably valued. We'll still be selective in picking the stocks that we like. Okay. Next question is from Neelam. She says, how will India as a country benefit in terms of manufacturing? Will foreign countries look towards India as a manufacturing hub like China? So I discussed that in some length. The China plus one strategy. A lot of production is shifting out of China towards countries like Vietnam, Mexico, and to a certain extent, even India. So India is benefiting selectively from in some sectors. Hopefully, India's PLI scheme that the government has come out with will help in that sector. It's still too early to say which sectors will benefit, but clearly specialty chemicals, APIs have already seen significant benefit. How are small and mid cap looking as many businesses seen setback due to COVID? That's a question again Fiza has asked. Clearly, Fiza, there are the mid and small cap sectors had suffered a lot in between, but the commodity rally that we have seen, steel, copper, chemicals, oil and gas, all of these commodities have rallied very sharply in the last 6 months. That strongly benefits a lot of these small and mid caps. and that's probably one of the reasons why small and mid caps have done so well over the last 3-4 months, because of this rally in thing. The general sense that we get is the steps that the government has taken in terms of giving out credit guarantees, etc., are working in ensuring that the banking NPAs are small, but also in that MSMEs are able to survive and grow. Right. I think one of the questions Trupti had asked earlier was, how will vaccination campaign help economy? Vaccination campaign is absolutely imperative. Without vaccination, there is no way we will be able to fully reopen. So the sooner that we are able to achieve this particular vaccination, the better it will be for the economy. The government says till December. We have seen other estimates that suggest that overall high levels of vaccination will only be achieved between March and June next year. But it's still, vaccination is absolutely critical for the economy to bounce back and normalize. Shivani wants to say which sectors will generate recruitment. Shivani, over the next 2 years, we think IT is going to be a strong generator of recruitment. BFSI is going to be a strong generator of recruitment. Some manufacturing sectors which benefit from PLI linked schemes could be a strong generator of recruitment. Something like electronics assembly, mobile assembly. Each of these things are very large labor component. So those sectors could benefit from this COVID impact, as well as the PLI schemes that the government has announced. Great. I think I have answered the questions that were there in front of me as of now. Retail segment. Pawan is asking about retail segment. Right. So retail has suffered the most, right? Shops have suffered the most because of lockdowns or curfews or restricted opening times. So outside of grocery, every retail segment has suffered, be it footwear, be it fashion, be it restaurants. Every retail segment has really suffered. They've struggled to pay up bills and so on. But once the economy normalizes after vaccination, we do think that retail will come back sharply, and there's a lot of pent up demand in terms of fashion, in terms of travel, in terms of restaurants and so on. So we do think that there will be a significant pent up demand that will come back and help the retail industry. So I think I have more or less answered all the questions that were put to us. We're about 5 minutes short of the time that we had budgeted. I would like to hand it over now to Fiza for the concluding remarks, as well as some of the other things that she wanted to discuss. Fiza, over to you.
Yeah, thank you, Aman. Thank you, Aman. It was a real great insight, and trust me, a lot of us are going to have benefits out of this thing, because the kind of sectors that you guided us are actually logically, which we can find it that they relate to the normal day to life basically. And as we see, a lot of things are moving out of China, and that was one of the major thing that you covered, it that India can get benefit on a lot of things from that stuff, and 1+1 strategy used is a good one basically. I'm sure people will be utilizing your inputs to buy the new stocks and everything. So thank you, Aman, for the great insight on this piece. And
Thank you to everyone on the call today for taking the time out to listen to this presentation. Thanks a lot.
yeah. So, guys, overall, thank you for joining us. I just wanted to brief you all that a minute more to hold you all back. HDFC Securities has come up a long way. You know, the kind of offers, the kind of value-added services that we have come up uh, are like amazing, are also very beatable and competitive in the market today. And I want you all to avail it, as you all are attached to us as an HDFC group. So extend your hands towards HDFC Securities family, and would like everyone to be a part of this thing. Our current success rate on our recommendations is around 82%. So do not miss the opportunity of earning and building more money. And we promise you that we will keep on coming down to you with such kind of more insight informations and insight knowledge about the markets and the economies for this thing. And do not forget, next Thursday we have a brief about the US economy and the US markets, where as a retail customer you can invest and expand your portfolio, diversify your portfolio and earnings. So do tune us again back. We will be sending you these links to join us on the US markets on next coming Thursday from 3:30 to 4:30 p.m. Until then, happy investing and goodbye to everyone.